Hey there, thanks again for joining me. This here is just going to be a quick commentary about what's going on with San Francisco real estate market in general and just maybe some current events going on around the San Francisco Bay Area. So let's jump right in. So first and foremost, we are seeing the headlines of more and more woes are coming to the San Francisco downtown market. So that's going to include the office space market, retail sector, and hospitality as well. First and foremost, the Wells Fargo building looks like that sold for somewhere between 43 to 46 million to an unknown buyer. We don't know who it is. The headlines aren't saying so. Wells Fargo paid $108 million for that building. I think it was something like 15 years ago. So they took a massive loss on this building after owning it for quite a while. They're moving a lot of their workforce remote. They don't need the building anymore, so they sold it at basically a fire sale. What we're seeing is that this pattern is continuing within the office space sector. So a few other notable examples of office buildings that are actually defaulting on their mortgages. So we have 55 New Montgomery that was owned by Swift Real Estate, which has a loan of, I believe, 62.3 million, and they bought the building for something like 64, 65 million back in 2018, I believe. And you also have New York landlord Columbia Property Trust, which is defaulting on their loan of $1.7 billion. They actually defaulted a little bit earlier this year. And that was a 7-building portfolio in San Francisco, and 2 of those were office buildings, specifically 650 California Street and 201 California Street. And then you have Veritas Investments, which is San Francisco's largest residential landlord, and they stand to lose control of over a third of their investment portfolio by defaulting on, I guess, a $448 million loan that is secured by about 1,700 units spread across 62 buildings in San Francisco. And so it looks like lenders are looking to sell over $1 billion of their assets that are tied up in about 95 buildings in San Francisco. A lot of this activity is being created or being facilitated by one of the highest vacancy rates that I think downtown San Francisco has ever seen, over 30%, I believe now, or almost 30%, somewhere hovering in that range. To give you some context, before COVID, vacancy numbers for office buildings in downtown San Francisco was closer to the single digits. A lot of the transition to remote work and the effects of the pandemic from a few years ago has significantly decreased demand for office space in downtown San Francisco. When you mix that with the increased, at least perception of crime and homelessness, that is causing a lot of this to happen, a lot of this vacancy rate. It's causing the building owners to not be able to afford to pay their mortgages on these properties, and in turn causing what could be a major crash in commercial office space in downtown San Francisco, according to a lot of experts. So unfortunately, this very grim picture is not just stopping at the office space sector. It is also continuing into the retail and hospitality sectors. So obviously we've heard of the headlines earlier this month and actually over the last few months of Nordstrom leaving downtown San Francisco, Whole Foods closing down their flagship market location after only a year in business. I believe it is Old Navy, and then a number of other retail well-known establishments have decided to close their doors and leave downtown San Francisco. The latest and probably the biggest blow to date, which is actually pretty huge, is going to be Westfield Mall. So Westfield Mall has decided to give up control to their lender of the property. They will no longer be managing it. As far as I know, it's still going to run the same, but from the sounds of it is that because their anchor tenant, Nordstrom, left their retail location and decided to close their doors, all of those smaller tenants within Westfield Mall probably have what's called a lease that's subject to the anchor tenant, this large Nordstrom, to be there. And so when Nordstrom leaves, these other tenants are able to get out of their lease. And I think that's, by the sounds of it, that's what's happening. And it's causing Westfield's Mall parent company, Westfield, to say, hey, we're done with this and we're leaving. And they're giving up control to the lender, and probably that is going to be sold also at a deep discount to what its value has been in recent years. Going to the hospitality sector, Park Hotels, which operate Hilton San Francisco Union Square, and Park 55, which are two of the 5 largest hotels in all of San Francisco, have also stopped making payments and went into default on their $725 million loan for those 2 properties. Hospitality, retail, retail office space in San Francisco, downtown San Francisco, taking a major hit. Now, what does this mean? This doesn't mean that all of this is just going to automatically get shut down. Whenever somebody stops making payments on a property, it goes into default, goes into foreclosure. That means that there's an opportunity, most likely, for somebody else to buy something on the cheap. And as we saw in the housing crash of 2008, this happened with the residential sector. A lot of people, yes, of course, lost their homes and went bankrupt and had major financial issues. But there were people on the other side who were able to buy homes on the cheap, flip them, and become profitable. So my prediction, for what it's worth, is that there is a good chance that somebody else will come in, buy all these commercial properties on the cheap, being able to have very low debt service and owning these properties and come in with low costs on that end will allow them to have a higher budget and bandwidth to be more creative with what they put in there. And a lot of these businesses that left downtown San Francisco in general are these legacy businesses that, have been replaced with online retail anyway. And so, the retail and office space landscape is changing drastically anyway because more work from home and people buying things online. You can't just only blame crime and homelessness and high interest rates created by the Federal Reserve. There is a changing economy that is causing consumer preferences to go away from going shopping in a crowded, busy downtown. So I think that as long as the city and the leadership of the city, both political and business leadership of the city, is creative and is proactive and is smart with what they do and where they try to make changes, then I think this could just be a short-term hiccup for the great city of San Francisco, and we could see a revitalization of the downtown area and make it a lot more thriving and popping if things are done correctly. So we'll just have to wait and see. As far as the hotels go, though, hospitality, that is alarming because I think at the end of the day, consumer preferences aren't really shifting with traveling, right? People still want to travel and take vacations, and I think a lot of what we're seeing with tourism down significantly in San Francisco in recent years is, of course, you have the pandemic, but even post-pandemic, San Francisco is down significantly more than maybe other comparable metropolitan areas. And the reason for that most likely is the at least perceived homelessness, increased homelessness and crime that is going down in that area and may cause people to avoid coming to San Francisco entirely. But we'll see if that gets addressed and changed by San Francisco's political leadership in coming years. So unfortunately, though, all of this news does look very grim for San Francisco's downtown and potentially having consequences for our local economy as well. However, it has not really significantly impacted residential sector. If you watch my two other videos, one with San Francisco real estate market data, where I review May 2023 versus May 2022 data, same thing for San Mateo County, you'll see that generally speaking, the real estate market is in line with what's happening with the national market. Prices have decreased. Things have slowed down a little bit, but inventory is also down significantly. Fundamentals are showing us right now, and what I'm seeing out in the field is that there are many properties are selling with multiple offers. I just listed a house for sale. We received on our offer due date after a week on the market, we received 19 offers and it sold for almost $300,000 over asking to an all cash offer. And that's a pretty extreme example, but what I am seeing is plenty of single family homes selling with 5 to 10 and more offers. Condos, townhomes, TICs, co-ops throughout the San Francisco Bay Area are much slower, but that is to be expected. That is normal. And so in general, the residential real estate market has not really felt major negative economic impacts as far as prices going down. Now, affordability is a different topic because with prices not being down that much, but interest rates being up significantly means that homes are even less affordable potentially than they were about a year ago when the market was just insane. And with less inventory, less to choose from, still multiple offers, it is still a very difficult and expensive place, the San Francisco Bay Area is, to buy a home. However, if you're working with the right agent, somebody like myself or someone from our team here at Rise Homes, we'll be able to get you in the house of your dreams. Don't forget to reach out if you have any real estate related questions or if there's anything I can do to help you. Again, my name is Joe Poliak with Rise Homes. Don't forget to hit the like button, subscribe to this channel, and give me some comments. Let me know your opinions about what's going on with the local San Francisco Bay Area real estate market and economy in general. Would love to learn from you as well. Thanks again.